market valuations are not sustainable. If there is one thing that I want you to remember from this article, it is that cold hard fact. In 1929, 2000 and 2008, stock prices soared to absolutely absurd levels just before horrible stock market crashes.
The Roaring '20s and the economic boom that accompanied it were coming to a close. By September and early October 1929, stock prices, which had reached great highs during the bull market, began to decline. There were false expectations. Investors began to lose confidence in the market, and the crisis of confidence led to a selling panic, and then the inevitable happened.
1929, Black Tuesday. The New York Stock Exchange is in a panic. Frantic investors have scrambled to unload their stocks at any price. Everyone wants to sell. No one wants to buy.
A serious situation. This past week has just been like nothing I've ever seen. One half under half. Every day, the market is just getting pounded and pounded.
Suffering through the last 8 years of class warfare on the middle class and the working class in this country. They had no money for the people in New Orleans, but they had billions upon billions of dollars for bailouts and for the war on the people of Iraq and Afghanistan, and we are sick of this f***ing bullshit!
This is serious. This is a major threat to our economy and its ability to create good-paying jobs and help working Americans pay their bills, to help Americans save for their futures and make their mortgage payments. Since this turmoil began over a year ago, the housing market has all but collapsed. Fannie Mae and Freddie Mac had to be effectively taken over by the government. 3 of America's 5 largest investment banks failed or have been sold off in distress. Yesterday, Wall Street suffered its worst losses since just after 9/11. We are in the most serious financial crisis in generations.
In fact, virtually everyone in the financial community acknowledges that stock prices are irrationally high right now. Some are suggesting that there is still time to jump in and make some money before the crash comes, whilst others are recommending a much more cautious approach. But what almost everyone agrees on is the fact that stocks cannot go up like this forever. On Tuesday, the Dow, the S&P 500 and the Nasdaq all set brand new record highs once again. Overall, US stocks are now up more than 10% since the election, and this is probably the greatest post-election stock market rally in our entire history. But stocks were already tremendously overhauled before the election. And at this point, stock prices have reached a level ridiculousness only matched a couple of times before in the past 100 years. Only the most extreme optimists will try to tell you that stock prices can stay this disconnected from the economic reality indefinitely. We are in the midst of one of the most outrageous stock market bubbles of all time. And as market watchers noted, all stock market bubbles eventually burst.
Believe me, we're in a bubble right now. And the only thing that looks good is the stock market. But if you raise interest rates even a little bit, that's going to come crashing down. We are in a big, fat, ugly bubble. And we better be awfully careful. And we have a Fed that's doing political things. This Janet Yellen of the Fed. The Fed is doing political by keeping the interest rates at this level. And believe me, the day Obama goes off and he leaves and he goes out to the golf course for the rest of his life to play golf, when they raise interest rates, you're going to see some very bad things happen because the Fed is not doing their job. The Fed is being more political than Secretary Clinton.
Everything the Federal Reserve did to stimulate the economy undermined the economy. That's the reason that Donald Trump is president, because all this stimulus made the economy so sick. I mean, what we need to stimulate is not stock prices or real estate prices or bond prices, but real economic growth. And that comes from underproductive consumption, from savings, from capital investment, and that comes from higher interest rates. That's what we needed all along, was higher interest rates, but we got monetary heroin instead. And so the economy economy never got healthy. It's sicker than ever, and that is the problem. And I do believe that the Federal Reserve is going to ignore Dodd-Frank was a bad idea. I mean, look at it. It was named after Chris Dodd and Barney Frank, two of the most influential members of Congress that helped to create the financial crisis because they protected Fannie Mae and Freddie Mac and they resisted all efforts to rein them in. The financial crisis was not caused by a lack of regulation, but by the central bank, by Alan Greenspan keeping rates too low, and by the moral hazards of Fannie and Freddie and government guaranteed bank accounts. So Dodd-Frank did nothing to mitigate the prospects for a future financial crisis. If anything, it accelerated them, because what we needed to do in the aftermath of the 2008 crisis was to take power away from the Fed and the government. Instead, they got more. But what scares me is to the extent that we do manage to roll back some of the regulation that never should have been enacted, and when the inevitable financial crisis hits, to the extent that it happens after this deregulation, I can already hear the left now blaming the crisis on that deregulation. That crisis is inevitable. It's going to happen whether we get rid of Dodd-Frank or not. But it was bad legislation, and we should get rid of it. But when we do, it is not going to be the reason that we have another financial crisis. The reason is going to be the Fed. The same reason that we had the first one is why the second one's going to be even worse.
And Peter, you said that investors are sort of missing the bigger picture here. They're so fixated on the Dow and that level there. You mentioned emerging markets as a potential space here. Where are you seeing the opportunities outside of the U.S.?
Yeah, I mean, they're happening in many countries. Just like if you remember when Bill Clinton was president and when his presidency ended and George Bush came in, there was a lot of optimism that the rally in the U.S. stock market would continue, that the strength of the dollar would continue, and instead everything reversed. And if you remember, the emerging markets had a lot of difficulties in the late 1990s with the Asian economic meltdown in 97, and there are a lot of things happening outside the United States. So emerging markets really got beat up also in South America or Latin America. But that all changed in 2001 as the U.S. stock market went down. Money started to flow back into those areas, and people made a lot of money in emerging markets, in commodities, in precious metals, in oil and agriculture. And I think the same dynamics are lining up again, only I think that President Trump has inherited a much bigger bubble from Obama than the one that Bush inherited from Clinton. And so I think the dollar's going a lot lower this time, and I think commodity prices could go a lot higher. So there's a bigger profit potential now than there was back then in the right markets.
The US stock market at this level reflects a combination of great demand, great complacency, and great greed. Stocks are clearly in a bubble, and like all bubbles, this one is about to burst. If corporations were making tremendous amounts of money, rapidly rising stock prices would make logical sense. But that is not the case at all. Corporate earnings for the fourth quarter of 2016 were actually quite dismal, and this disconnect between Wall Street and economic reality is starting to really bug financial analysts such as Brian Sozzi. The S&P 500 has gone 89 straight sessions without a 1% decline. Considering that corporate America didn't exactly light up the top and bottom lines during the fourth quarter, such is taking rather troublesome. Granted, the stock market is a forward-thinking mechanism that appears to be trading on hopes that Trump's unannounced stimulus and tax plans will be lifting economic growth in 2018. Even so, the inability of investors to acknowledge persistent struggles amongst companies and ongoing chaos in Washington is starting to become disturbing. It is a fact of economics that stock prices should accurately reflect current and future earnings. So, if corporate earnings are at the same level they were at 2011, why was the S&P 500 risen by 87% since then? The following comes from Wolf Richer. The S&P 500 stock index edged up to an all-time high of 2,351 on Friday. Total market capitalization of the companies in the index exceeds 20 trillion. That's 106% of US GDP for just 500 companies. At the end of 2011, the S&P 500 index was at 1,257. Over the 5+ years since then, it has ballooned by 87%. These are superlative numbers, and you'd expect superlative earnings performance from these companies. Turns out really is not that cooperative. Instead, net income of the S&P 500 companies is now back where it first been at the end of 2011. The cyclically adjusted price-to-earnings ratio was originally created by author Robert Shiller, and it is widely regarded as one of the best measures of the true value of stocks in existence. According to The Guardian, there have been 2 times in our entire history when the ratio has been higher. One was just before the stock market crash of 1929, and the other was just before the bursting of the dot-com bubble. Traditionally, one of the best yardsticks for whether shares are overvalued or undervalued has been the cyclically adjusted price-earnings ratio constructed by the economist Robert Shiller. This ratio is currently at about 29 and has only been higher in 1929, ahead of the Wall Street crash, and in the last frantic months of the dot-com bubble in the late 1990s. We could definitely wish for current euphoria on Wall Street to last for as long as possible, but let there be absolutely no doubt that it is going to end at some point. It would take a market decline of 40 or 50% to get the cyclically adjusted price-to-earnings ratio back to a level that makes economic sense. Let us hope that the market does not make such a violent move very rapidly, because that would likely be absolutely crippling for our financial system. Markets tend to go down a lot faster than they go up, and every other major stock market bubble in US history has ended very badly. And this bubble is definitely overdue to burst. The bubble market that led up to the great crash of 1929 lasted for 2,002 days, and this week the current bull markets will finally exceed that record. Trying to pick a specific date for a market crash is typically a fruitless exercise, but market watchers are becoming very concerned about some of the signs that we are now seeing. For example, the OCT indicator is currently showing the lowest bullish energy ever. The first factor is the CCT indicator. This indicator is proprietary internal measurements of the general volume of the New York Stock Exchange. The measurements take into account the institutional participation of ratio of the overall volume, also measured in the duration of heavy block buying in rallies. The sum total of all measurements now shows that the lowest bullish energy ever, even lower than in 2008, just before the market crash. In other words, the current bull market appears to be completely and utterly exhausted. The laws of economics cannot be defied forever. Traditionally, commodity prices and stock prices have tended to move in unison. Makes sense. Because commodity prices tend to rise when economic conditions are good, and in such an environment, stock prices are typically going to move up. But now we are in a time when commodity prices and stock prices have become completely disconnected. In order to bring this ratio back into line, the S&P 500 would need to fall by about 1,000 points, and such a decline would cause a level of financial chaos that would be absolutely unprecedented. This current stock market bubble has lasted much longer than many of our experts originally anticipated, but that just means that the eventual crash will likely be that much more devastating. In the end, you don't need to know of all the technical details in this article, but what you do need to know is that the current stock market valuations are not sustainable, and that a great crash is coming. It may not happen next week or next month, but it's going to happen, and when it does happen, it is likely to make what happened in 2008 look like a Saturday picnic.
It's not a question of will that happen, it's just a question of when.